look at what happened at earnings last night. You can see it popped. It went all the way up to 519. You guys see that? And now, of course, we're getting its normal pullback, right? Because it typically doesn't stay all the way up there. This is just FOMO, right? Everybody starts buying in. Even in the after hours, everybody starts buying in. It continues to drive the whole thing. There is no halts. It just keeps on going and going and going. And this thing just shot up like a rocket. You guys saw yesterday that I did a lotto. So if you guys did a lotto, congratulations if you were in the call side. Remember, it was a 50-50 shot. It is a gamble whenever we lead into earnings. So don't load the boat. It could have went the other way and you get your face ripped off. I saw somebody who's, some people were wanting puts. Think about if you loaded the boat and you did puts, right? Because you're like, oh, this can't sustain. There's no way, right? Oh, I bet you they had bad earnings because there wasn't enough chips. Oh, so if you'd have went the other way, you'd have lost everything you had. That's why I said it's a gamble through earnings. So yesterday, what I did, and you guys know through earnings, what I love to do is I love to do a straddle or a strangle. Typically, I'll do a straddle. So here's what this looks like for those of you that don't know, or those of you that are new. What you can do is what a straddle is. So this, we'll just say this is the stock price. A straddle is where you buy a call and a put. I put them on each side because, right, you're assuming one goes up, one goes down. You buy those for the same expiration date, okay? Same EXP expiration, and you buy them for the same strike price, okay? So what you're doing is you've bought one that goes down and you bought one that goes up, all right? Now, because it's an aftermarket play, there's no way to put in any stops, but I'll tell you guys how to do that in a moment. But what this means is, let's say, because remember, it's a lotto. Let's say we spent $100 here and we spent, I don't know, $70 here. First of all, can somebody tell me why it's cheaper to buy a call than a put?
Because it's predicted to go down.
Because
A put pays both ways
there you go. So a put,
when it consolidates and goes down.
that's right. So a put will pay you when it sideways, consolidates, or goes down. A call will only pay you if it is going up. So puts typically will always cost more than calls. So you had 70 to the upside. Okay. You're saying, hey, I think it's going to go up. You got 100 to the downside because you're like, hey, it's going to go down. Now, why the hell would this make sense? Let me show you why. Because in earnings, when we write a straddle, we are playing on volatility. We want it to really move, right? Just big volatile. Thank you. We want it to move in a giant motion, which it did, right? It's up here almost 7%. Well, why does that matter? Because in this instance, the call to the upside is going to super pay. This will probably 4x, right? So if I make even, let's say 2x, if I made twice the amount of money on my call, that's $140, right? And then this one is going to be a dud and it will probably lose, right? X amount of dollars. We'll say it'll probably lose $60, give or take, whatever that number is, right? So you take the difference of what you made on this one versus what you lost on this one. This one you'll end up stopping out, and this one most likely will continue to run. And typically you'll make 2 to 4 times the money on the open, though, on this one, and this one is just a wash, right? So it has to be so much that it will override the other one, pay for it, and continue to run, right?